decided today to increase interest rates for the first time, the very first time since 2018, since 2018. So it's a big deal. Why? Because it does have a pretty significant impact on money, because we use money to buy stuff. We use money to invest. We use money pretty much in our everyday life. So it is really important to pay close attention, to pay a close look, because these interest rates is not going to be a single one for the remainder of this year and even going into 2023. There's going to be another round, many more rounds into these interest rate increases will impact the way you pay debt, the way you handle credit card, the way you buy stuff, and as said, the way you also get into managing your money on a daily basis. But here in the US, let's look at the four things that definitely we as American on our lifestyle, we use interest rates. Credit cards, because in order to get stuff, we usually, buy those using our credit card. And credit card, we have what we call the APR. So that it's tied to the interest rates. But we also have the way we invest, because many people invest in the stock market using margins, and that margin is kind of like a quick short-term loan that your brokerage firm will give you in order for you to use that money to take some risk into the stock market. So if interest rate increase and that is a loan, then also ultimately it might impact the way the stock market will behave, hence your 401k, your IRA, your 539, or the other stocks that you may be holding. Also, the most important thing is real estate, because real estate ultimately runs on credit, on debt. In order, whether it's for buying just a house you're going to live in, or it's for a commercial building, or it's for investing property. So all of that will be impacted by how interest rates move. So let's look closely at the very first one, credit card debt. Well, your credit card debt, if your interest rate increase now by 0.25%, and it's going to continue to increase by that amount, or by 2 times that amount in the next 6, 9, 12 months, 18 months, you want to pay attention to that, because if you are paying a $25 now in order to service that credit card, it may cost you $50, I don't know, next month, or $75 in 3 months. I'm just caricaturing here, but the point is, it's going to cost you a lot more money. Same thing if you are already using or you're already paying a mortgage. That mortgage, definitely right now, especially for people willing to buy a house, it is already so crucial for some people to actually qualify, because interest rates are already increased, and by doing so, the market will be readjusting. So meaning somebody that was paying 2.7% mortgage on a house last year or the beginning of this year, we are already looking at 375 or 379 or potentially 4% starting by the end of this month. So it may hurt people who are already in the process of buying a house, or already in the process of, or we're looking to buy a house, because it's going to be a lot more expensive. All right. So ultimately for you, if you're looking to buy a house, it means either you will have to come up with a bigger down payment on your house, or it means you will have to come up with a bigger collateral if you are willing to pay down, put down a little less money in order for the bank to give you the full amount on your mortgage. All right. Now, it may also mean that, it's going to balance the way the real estate market will actually behave, because we have some new houses, some new supply of properties coming into the market. That's going to balance the frenetic, demand that we've seen since 2020. All right. So it might push the price of real estate a little bit down, stabilizing it depending on the location and the area you're living and willing to actually buy. So it may it may make more sense for you as a potential buyer, for a house, to actually wait and see. But nobody knows exactly how the future will hold. But if I was in that shoes, that's what I would go as a direction. Now, something to also take into consideration is the car business, because people were looking to buy cars since the pandemic started. And because we have these supply chain issues and the chip shortage, it created also a significant It created some changes into the car market. Used cars were way more expensive than they used to be a couple of years ago, a couple of months ago, which made sense. But now that not only we have a lot more cheap factories being built, but by the time they are here for the market to stabilize with the supply and demand, the interest rates on car loans is also going to be impacted. Let's just give a quick look at a quick example. Let's just say we have a quarter basis increase, which is already the case now. Ultimately, we'll turn an average rate just under 5%. All right. This is from Bill Lightsey's Vice President and founder of Credit IQ, subsidiary of Cars.com. Someone taking out a loan to buy a $37,000 car. This is a new car. Now, will incur a $4 or $5 extra monthly interest cost at 5%, compared to a 4.65%, 67%, and between 340 and 400 extra interest costs over the life of the 6-year loan. If you now go to a 26,000 used car, the extra monthly cost could be around $3 and come to more than $200 extra interest rate in the life of the loan. Now, remember, we're talking here about just the impact of one increase of 0.25% on interest rates. But we're going to have 11 more, potential 11 more coming in the next 12 months. So what that means is you're going to actually have to multiply this by 11. All right. So again, it's going to make things a lot more expensive when those things are being bought and maintained by debt. All right. So ultimately, to end this video, if you are already in a position where you can actually pay off that debt very early or sooner than you expected, because if you keep servicing it and maintaining that debt is going to cost you a lot more money. All right. So with inflation, even though it's going to come down a little bit, if you want your money to continue to produce and to not being eaten out by inflation, you have to make it work for you while you sleep. You have to put it somewhere where it will make sense to continue to produce an income. So that's why I'm suggesting it will make sense to actually make sure that you pay off that debt and put that money to work either on the stock market or either wait sitting on the sidelines to build some cash, because when the real estate market corrects, which I believe is going to happen, then you could be in a position of actually buying and investing property to also give you that passive income, because that's how ultimately we have to make sure whether we are going to a recession or no, these interest rate increases will not refrain us from building wealth consistently. And that's the ultimate goal.